Hi, hello everyone. Thank you. Well, this hangout is a re-recording of the last one because after I stopped the hangout, I realized it's take way too long. It's like 50 to 54 minutes, and I was trying to stick to 20 minutes or less than 20-minute session. So to value your time, I try to make a shortened version so you don't have to go through a whole hour of material, although I do have a lot of material to cover, but I'll try my best to shorten it and make it easier to digest for you. Okay, so let's get started again. And for this hangout, let me see, I have a sound. Okay, yes, good. So for this hangout, we talk about the financial game plan and how knowing your goal. Let's begin again with the disclaimer. I'm not a financial advisor, CPA, and attorney, so I'm not giving financial advice. I'm just pure education for your own good, or for me to share the knowledge I have with you. So I hope you would able to learn from it. And but again, it's just personal opinion, and it's not a financial advice. Okay, so financial game plan. In the last video, the last one, what I mean, in the last week, talk about the understanding your options. We talk about, let me come back here a little bit, talk about the different type of income, the active income and the passive income. And I know that it's a little bit small for you to read, but it's okay. We're not focused on this. So active and passive, and the passive income, portfolio income, and so on, and different asset types. So, but I didn't really talk much about the financial game plan itself. Okay, financial game plan. Why it is called a game plan, right? Because life is a game, if you think of it that way. Because there is a certain rule to win and certain rule to lose, and we want to define what's mean losing. Well, as I click on this, let me quickly go over there. What's mean losing? And one of it is this: when you retire, you die broke. And we come back to that. I just get ahead of myself as I click the wrong button. So as a financial game plan, it's a part of a life is a game. And go back. It is it is a key part of a bigger game plan, which is the wealth game plan. When you look at yourself, your life as a game, you need a game plan to how to play your life well. But the wealth game plan is a much bigger picture of what the financial game plan is, and it is in the realm of timely wealth. So it is out of scope of this hangout. But so I will only go over what it really means, the key mission, the grand mission of the wealth game plan, and it's the same idea applied to financial game plan, which is the grand mission. Do that. It is to create asset to generate value. It could be for you, for anyone that you love. Okay, and so what does it mean is that in order to get any value out of anything, or I should say, if you want to get some value, get what you want something, it's never really you're able to get that value directly. If you think about it, you can only get it through some form of asset. For example, in the video I just made, we use I want to have an egg for breakfast. Right? How do I get the egg? I need to buy it. How do I buy it? I need to have money to buy it. How do I make money? So I'm making money, and then the money as an asset, and I use that asset to trade, in this case, to trade. And and buy an egg and eat it. And let me backtrack a little bit further. In order to get that money, because money is just a vehicle, what I really need is I need to have a job to create an income. So my job or my knowledge, or trace all the way down, or my knowledge creates the assets all the way down until at the end I get an egg and I able to have it for breakfast. The same for if I am a farmer, I would need to put the raise the chicken, feed the chicken, and so on, so that the chicken, which is an asset to the farmer, would produce an egg that I can have and eat it. So that's a key idea I want to share with you. That's for almost everything in our life. That's how things work. So in the financial game, what do we need to do is to create, achieve, or acquire asset which generate the cash flow to us, so that we can use the cash flow, use the money to buy whatever we want, pay whatever expense we want, and live our life. So that's the general statement of what do we want to do in the financial game. And in a game plan, when we talk about, first, before I talk about a game plan, we talk about the game itself. The game has several components that we need to understand. First thing is definition of win. What do we mean? What is that game is? And the game is a financial game, and then what they mean by winning. So the winning, for one thing, is I would just cut down to the core of it, which is financial freedom. What do you mean by that? Financial freedom means, will it be too small for you? Let me expand it a little bit. Okay, I hope that would be a little bit better. So financial freedom is meaning your passive income or portfolio income is greater than your expenses. Okay, that's the definition of financial freedom, and I'll cut the details because we want to get to the spreadsheets. So another one is the lifestyle freedom that I define. So the lifestyle freedom is basically saying, if you don't have issue of money, you have unlimited supply of money, how would you like to live your life? Okay, then look at those expenses. How much passive income and portfolio income you need to make to able to desire lifestyle expense, to able to pay your desired lifestyle expense. Okay, if you're able to do that, you would able to, quote unquote, live your life happily ever forever. And then the third one I didn't talk about in the last email is about legacy. So create your legacy, create a multi-generation wealth, but we can skip it for the next hangouts, for the other hangouts. So besides talking about the definition of win, it is also good to talk about what does it mean by losing the game. And losing the game, losing the financial game, could mean you're bankrupt. Bankrupt, or you live below your mean, or you retire broke. So when I talk a little bit about live below your mean, because bankrupt, we understand what it means. We also understand what it means by retire broke. Or I should really talk a little bit about it, retire broke. And according to a lot of studies, one of it is from the Bureau of Statistics and the Department of Social Security. For 100 people that at the start of the career and follow them until they retire, only one of them will be wealthy. 4 of them will be financially secure. 5 of them will continue working, and 36 of them will be dead, and 54 of them will be dead broke. So meaning if you don't have the right financial education, you'll be one of the 54 people out of 100 that will be that broke. And that's one of the definition that we could put in as losing the game. And back to live below your mean. What I mean is that a lot of people would say live below, when you start working, you would save, you will reduce expense, and so that you can save enough money so you can have a bright, better future. You can make a lot more money and so on. It's fine and dandy in some sense, but that's kind of not applied to today's world, in the sense that because of the money is lived off, it's become just pure debt, and it's off the gold standard, the whole 9 yards. Don't want to get too much deep into it. That saving is actually not a way to really become wealthy or become rich. Okay, and live below your mean also have a negative impact on your morale, your family, or for you mentally, you just don't won't be as good as if you're able to live within your mean, right? Of course, I'm not saying that you should live beyond your mean, which is not a good thing either. But what we should really focus on is about how to increase our income, and so that we can raise our mean and live within it, instead of just thinking about live below your mean, because live below your mean meaning contracting, getting smaller and smaller. And it's not necessarily a bad thing, but I just want to say that depends on who you are. You might consider that as one of the definition of losing the financial game. So the third thing is, let's talk about a little bit game rules, okay? And the game rule is pretty simple. What we do, we should be ethical, legal, and moral. So anything besides that is up to you. It's a very free game, right? You can do anything with your life or with your finance, as long as it's follow these 3 rules. So the sky should be your limit, of course, within those game rules, right? And then another thing is talk a little bit about the strategies. There are several things. This is something new. Is besides the diversification, which I talked about in the last recording of the same topic. But besides the diversification, there's also when I go live, I can't spell. Utilization, risk management, and leverage. That's several things. Oh, it's okay. Risk management. These are the 4 things I actually want to talk about, but I didn't in the last recording. I only talk about diversification, and diversification, which is good, but there are 2 things I want to point out. I again try to keep it short, unlike the previous one. One is about are you diversifying? Are you truly diversifying? What I mean is when a lot of people invest in stock market, they invest in index, mutual funds, and so on, and think they are diversifying. But look at 2000 and 2008. What happened when the market crashed? It's the whole system crash, and that kind of diversification won't help you. So you should really think about is besides paper, diversifying in paper, you should diversify in multiple asset type. And the asset type we talked about already in the last week video is paper, business, commodity, and real estate. And in 2008, I want to point it out is that in 2008, paper and real estate both goes down. The public trading one, again, the paper private one is not as heavily affected. What we now know is about the public one. And on the real estate side, also, if you were investing in just residentials and buying for appreciation, then in 2008, you might have lost a lot of money. But if you were doing some income producing, like rentals in residential, you can also rent it out and it make cash flow, that's fine. Or commercials that create a cash flow. You on paper, you still lose some money, but you might still doing pretty well because your asset is still producing the income for you, right? And in some sense, the apartments or multi-unit actually could get better. And another thing I didn't add last time is, for example, self storage. It becomes better because when people take a hit during 2008, they lost their home and they have to go back and live with the family, or they have to live in apartments. So think about what will happen to the apartment or real estate market. It goes up, right? The same thing goes for self-storage. It becomes better. Of course, different real estate or different assets have their own cycle, and that's what part of the knowledge that you should have as you progress in your financial education. So go back here. That's the diversification part 1, and diversification part 2 is the phase that I forgot is Robert Kiyosaki said, or is Warren Buffett, or who said it, is you focus to make money and you diversify to keep money. So in order, if you depends on what your position is right now, do you focus or should you focus on making more money, or you have money and you want to diversify and keep it? Because it's only when you, just like you're doing anything, only when you focus, you can make a lot of progress. If you diversify it, it will kind of save your bottom line, but your return will, because of the nature of risk versus return, when you diversify, you have less risk, and most typically you will make less money, but you're able to keep it. And these three are new. So one is the utilization. On the strategy, one thing is if you have some form of asset, how do you utilize it? How are you able to utilize it? Are you able to leverage it? Or are you able to use them? What I mean is, are you able to use them to create cash flow, create money for you? Because if you hold some gold, you have some jewelry, it's good, you have that asset, but if not producing money, it might not doing much for you. Or again, the example I used was you have a whole bunch of money in the bank, but if it's not earning interest, not doing investment, doing nothing, it's doing nothing for you, and you're not even taking it out to improve or buy what you need to live on, then definitely it's not doing anything for you, right? And if the value, the currency value goes down, then you actually losing your assets buying power, and it's double down. Okay. And what the one last thing is about risk management. And so when you talk about your financials game plan, you need to basically manage your risk, right? As I mentioned a little bit over here, the risk management is always a risk over return. Do you want to take more risk and it has higher return, or you want to have less risk and lower return? Of course, different asset type is different, right? There might be some better asset type at a certain time period, and some other asset type may be not as good. And when times goes by, things change, right? So how do you able to pick out the right asset and have the right risk management? Or we say one of the key thing in here is a balanced portfolio. How do you manage to have a balanced, well-managed portfolio that you could have the right amount of risk and while maximizing your return? All right, so that's talk about the game plan itself, and let's go to this. So before I show you the spreadsheets, one main thing I want to show you is about am I drawing? Oh, here, there you go. How do you measure your finance? The answer is this: your financial statement. And everyone really need to understand what it means. There's an income and there's a balance sheet. Not that, okay, that's not a very good acronym. So let me balance sheets. Okay. Okay. This is an income, it's good enough. So how do we increase income? This is the money coming in. It could be your job, or you could have assets and which generates passive or portfolio income for you. And for the income that you get, part of it goes down to pay all the expense. Part of it actually go back, become an asset. And you also have liabilities. Liabilities, it will become, if you need to pay, for example, you have a mortgage, you have money payment, then it adds to your expense. And if you have money, your assets, you can pay off some of them. Okay. So this is the basic income or your financial statement. So I won't get too much into detail. I spent a lot of time on the last video. So on this video, I will just keep it like that. The only one more thing I want to talk about is about the net worth. So if you get all of your assets, everything over here, minus everything you have liabilities, it equals your net worth. Right. So the key in the financial game plan is how to increase your net worth and how to increase also this income. If you have the income minus all your expenses, it is your cash flow. And so the key is how to maximize these two numbers, how to increase and maximize these two numbers, increase your net worth or increase your cash flow. And which one should you increase? It will depend on your situation. And that's a much bigger topics, and we will talk about it in future hangouts. So let's go to the spreadsheet. Again, this is spreadsheet is a spreadsheet that I created for you to realize your goals and keep track your progress. And originally this was saying checkpoint 1, 2, 3, 4, just like here. But from the last video, I was building it out, and so I forgot to clear up. So let me just quickly show you. I make a little bit change compared to the last one, because you can see the last one has some problem. And from here, you put in your name, and for the demonstration, I use Joe. Sorry, Joe, but it's a fake Joe, or John Doe. Let me do that. And the network utilization and this estimated return, I will come back to it again. And this is the financial freedom and lifestyle freedom. The financial freedom, we talk about that, is the passive income, or plus, I really should say plus your portfolio income is greater than your expenses. When you're able to do that, basically it means you can have the option to quit your job, right? Even you quit your job, or you get laid off, then and you can still survive with no problem. So that's financial freedom. And the lifestyle freedom, again, is the income, the passive income plus your portfolio income will be greater than the expense you need to have your desired lifestyle. So this is the financial freedom and lifestyle freedom, and let's dive into it. And then we go back here to see a summary. And using John Doe as an example, then we start to fill it in. Okay, so you have two sides. This is the income statement side, the income side, and then on this side is the balance sheet. Okay, let me show you on another one, so you can see that on one side, on the other side, it changed a little bit, changed the format a little bit, because I realized for the bug that I have on the last time, it's better to organize it this way. Anyway, so back to this. So what you would do at the beginning is to start filling them out, and you would fill out your current expense and estimate it, how much you spend on transport, auto, for example, $200, and $200. I'm putting $500 in education, and $50 in entertainment, and $600 in food and dining, and so on. And I don't have, let's say 50. Or for the PITI, let's say keep it the same as 2,000. And there's John Doe, not me. This is a hypothetical example, okay? And pets, I have John Doe. John Doe doesn't have any pets, and John Doe doesn't like shopping. And taxes, let's say I have to pay $2,000, just for really an example. So I have a job, and it is making me $6,000. And then I don't travel much, but let's say let's budget $100 per month for travel, and you can see that the monthly cash flow over here is 300, and the target passive income is basically is the same as the total expenses that you have. It's very simple. and the financial freedom progress is 0% because I don't have any passive portfolio income here. So let's add some of that. Let's go over here a little bit first and say, let's go over what kind of assets do I have. And I changed the layout a little bit. So what this means is I have, let's put in a saving. I have a saving account, for example. I have $10,000 in there. And skip the, if you have an entry on asset and there's no corresponding liability, keep this empty, because the equation, all the stuff leads you to do that. So another one is I can say no number one, as we're doing just the investings, and we put in $50,000. We have a loan of $50,000. Oh, yeah, for the previous example, I was also doing that. Okay, and then I have a home, not home, home. I would still like to say as primary residence, and it worth, for example, $600,000, and there is instead of a mortgage, I look at all the well, it's still a mortgage. Sorry, I have a mortgage of $400,000, and this one is I'm utilizing it. What it means, one thing I want to mention that is it is a one-to-one pair, right? As I said, if you don't have any liabilities, keep it empty. Or if you have a student loan, then you say there's a student loan and of $200,000, for example, and then keep this one empty. If not, the equation will kind of will likely mess up. So say it like this, and what does this means is the saying, is this asset being utilized? So and why, if the asset is already utilized in generating passive portfolio income for you, remember to enter the income in the monthly passive portfolio income session. So let's do that. So for the long one, I am making one. I'm making, let's say, just 10% or less than. That's 10%. All right, doesn't really matter. So say I'm making $400. So from there, since my passive income target is 5,700, my financial freedom progress is 7% because it's a 400 over 5,700. So that shows you your progress. And over here, can see that it is utilizing, my net worth is only 80,000 because I have these liabilities and only have that amount of assets. And among them, there are 50K I already used to leverage. So, but for the example, let me take this away to make it looks a little bit better to show the point. So with that away, my net worth utilization is only 18%, meaning I might able to leverage some of this, right? For example, if this would means that I could, for example, get a HELOC of $100,000. And when you have that, you might able to utilize it, right? So, and one more thing about here, about debt to asset ratio, is that this calculates how much debt versus how much asset do you have. If you have a lot of debt and a lot of ratio, this will be very high, meaning it could be risky unless you have the right education. And as in the last video, I really wanted to show you this about the US national debt. And you can see that on the US national debt, there are $18 trillion, 18.3 trillion. And the US assets, it only has the US GDP, only have 17.8 trillion. So it is more than 100%. So we are, the US government is not doing very well as a nation. And not to say that there is 97 trillion unfunded liabilities. We can talk about it in future hangouts. So it is a very, very not good situation. So again, you can go to this place, which is, you can just Google it. It's usdebtclock.org. So you can Google it and take a look at it. It's fascinating. So let's go back to this one, because I already more than 20 minutes now. So after you fill it out, you can see the summary over here, how much you are earning in the earned income, how much you're making in the passive income and cash flow and so on. That's the net worth, the utilization over here. And this is your target, this is your progress. And these are the links that when you click on it, it will just go to the respective tabs. And here, when you're filling it in, you fill in your start dates, and then you can fill it in 3 months, 6 months, annually. So to have a different checkpoint at those time, so you can see how much did you progress, are you moving along, what do you like your progress, what should you do. And on this net worth utilization, this is the hypothetical utilization, saying that, for example, here currently you're using 18% of your net worth to generate the passive income and portfolio income. So this is saying, what if you were able to utilize 60% of your net worth? And when you're using 60% of your net worth, they are generating 4% of return for you. You can change this number, and depends on your risk tolerance, depends on what you think you can make. Change those numbers and it will reflect. For example, if I change it to 8%, it will become like this. You can see that the potential progress becomes 32 and 1800. If you go it back down, it goes down. So it shows you what could you do when you have that net worth. So one of the strategy you could do is try to increase your net worth, then you can see the potentials, and then increase your utilization to achieve what the goal that you have, in this case, the financial freedom. And the same things over here for the lifestyle freedom. You would do the same thing. The only difference is, instead of writing down your actual expenses, you write down your desired lifestyle expenses. What do you want to have? How much travel? How much money you want to budget for your travel, and so on. And you can add a lot more other stuff down here. And of course, by the time you might consider taking away your job and just focusing on passive, but it's completely up to you. And so the last things before I end this call is, when you go here, you could, for each of the checkpoints, you could copy, you get the same number as you have in the financial freedom or the original tab, depends on where you are, or you can adjust it, because as time goes by, your expectation will be different, right? And so you could, it's completely your call, it's your life, it's your game plan. So you can change it however you want to suit your needs. All right, I'm checking out. I hope this time will be a little bit shorter and a little bit easier to understand. And we'll see you next time.